Welcome back to yet another episode of E.M.I. This is the E.M.I. for the month of February. In this month's E.M.I, we ask three key questions. First, what is the key near-term challenge ahead for the RBI? Why is the rupee dependent on FII flow momentum into the months ahead? And lastly, and most importantly, what is that one positive wildcard variable that can completely change India's fortunes? Let's jump right in to these three key questions. In this slide, we address the rupee, the RBI's FX intervention, and how it really impacts liquidity. The chart on the left here shows you the direction of the rupee over a period of time. So whenever you see the dark blue line moving lower, it means the rupee is depreciating more and more. And the light blue line is the liquidity in the system. So the liquidity, you can see the zero mark here. So the liquidity has been in surplus all of this phase. And below zero is where the liquidity has moved into deficit. So you can notice here that after September of 2024, you can see that the liquidity has started turning deficit. The main point here is, why is the rupee and the domestic liquidity in the system, why are they so interconnected? The answer lies in this chart on the right. If you plot domestic liquidity into the system and you plot the RBI's dollar purchases, you notice that they almost always move in directionally the same line. Why so? Whenever the RBI intervenes in the market, they intervene in the market for two reasons. They either buy a lot of dollars or they sell a lot of dollars. And the RBI intervention in the forex market is always to smoothen the volatility in the RBI, not exactly targeting any particular exchange rate. So if you look at this chart here, the RBI's dollar purchases, this is moving in line with your liquidity in the system. Whenever the RBI buys more and more dollars, net dollars, it means that they are actually pumping in liquidity into the system. And whenever the RBI is selling dollars, they are draining, they're actually buying rupees, and the liquidity in the system is actually draining out. It's turning more and more into a liquidity deficit. The last few months, the period that we were talking about post September 2024, the RBI has increasingly selling more and more dollars, which means they're buying more and more rupees, which means the domestic liquidity in the system is turning more and more a deficit. This is that key relationship as to why the liquidity in the system is closely related or closely reflects the direction of the rupee, because the RBI keeps intervening to smoothen the volatility in the system. Whenever liquidity turns deficit, you largely actually also see the RBI stepping in to try and see if they want to offset this liquidity deficit with various tools. So the last few months, when liquidity turned significantly in deficit, the RBI had to announce a fair bit of OMOs. OMOs are nothing but open market operations, where the RBI gets into the secondary market, buys more and more of bonds, and when the RBI buys bonds, they are infusing liquidity in the system. So when the RBI is selling dollars and creating a certain liquidity deficit in the system, to offset that, they buy bonds and they infuse liquidity in the system. So the liquidity deficit is largely offset to a great extent. The reason why we have not seen OMOs for nearly 3.5 years or so is mainly because of the fact that the system was not in so much of a liquidity deficit as much as it was in the recent past. And the point here is the April 2022, this liquidity deficit that you can see isn't related to RBI intervention. It's probably something to do with government expenditure not picking up to the pace that it should have. So this is the first slide where we talk about why liquidity deficit in the system and RBI interventions are closely linked, and how the RBI uses OMOs to offset this liquidity deficit to a large extent. Now we come to a very important topic, the current account deficit and the financing of the current account deficit. Now, current account deficit moving lower is something India wants. India wants a lower current account deficit, which is why the government focuses on the PLI. They want to really boost India's exports. They want export growth to really start picking up. They want a certain amount of import substitution also coming in, so our import dependence comes down. India's services exports has actually been picking up over the last few years. So if you look at India's exports, you can break down India's exports into two: service exports and goods or merchandise exports. India has a deficit on merchandise exports, which means India imports more goods than it exports. But on the services side, India has a services surplus or a trade surplus, which means India exports more services than what it imports. Now, the services surplus, the larger and larger it gets, it helps offsetting the trade deficit to a large extent. Now, what matters here is India's current account deficit needs to be financed. What finances this current account deficit? So India, when you say India has a current account deficit, it means that India, India is a net importer of goods, largely merchandise goods here. Now, that importer of goods, how do you finance this import bill? If you look at this chart on the left, top left, you can notice here that there are two items that we've sort of colored in dark blue and slightly lighter blue. This is FDI and FII. These are the two items, elements that have largely been responsible for financing the current account deficit. What has changed in the last few quarters, or rather the last few years? If you look at the period post 2023 June, you can see that the dark blue line dominates. The dark blue line is FPI or FII flows. FII flows have been accounting for a much larger share of India's capital account surplus, what actually finances the current account deficit. That turned negative in the December quarter, and the FDI support also waned away in the last few quarters. All of a sudden, your FDI support for your current account deficit, your FDI financing of the current account deficit completely turns negative, and your FII financing of the current account deficit also turns negative, which means that India is still importing X amount of goods, but the amount of money that it has to pay for it, there seems to be a mismatch. And that is something where immediately you see a reflection of the currency. So on this chart on the right, we've plotted the adjusted balance of payment surplus. So what do we mean by adjusted balance of payment surplus? So your current account deficit plus your capital account surplus is equal to your balance of payment surplus. We are in balance of payment surplus because until now, we had a fair bit of amount of money in the capital account that could finance the capital account, current account deficit. Now, when we adjust for it, we adjusted it for a few items here. So if you notice on the footnotes here, we adjusted the capital account for the FDI earnings that are reinvested and SDR issuances. These are not in dollar terms, so we sort of adjust it. So it is only dollar to dollar that we're looking at. So whenever you see the adjusted balance of payment surplus moving up or moving down, the delta in the rupee moves exactly in the same direction. And December, it's very likely that your balance of payment surplus has moved lower, and as a result, directionally, the rupee also moves in the same direction. The chart on the bottom left talks about the amount of money that the RBI generally has to intervene in the markets. Historically, if you notice, the amount of money that the RBI has to intervene in the markets is almost exactly the same amount of balance of payment surplus that India has. So if India has X amount of balance of payment surplus, that's probably roughly the amount of money that the RBI has to intervene in the spot market. So what's the quick takeaway from this slide? Financing the current account deficit moving lower is important, but what is equally important is the financing of this current account deficit. The last few years, you saw FII money increasingly financing the current account deficit, which sort of was indicating to markets that the probability of a currency depreciation, if FII flow suddenly turned around, was much higher. And that's exactly what happened in October of 2024. You saw a sharp outflow of FII money from equities. Debt still was positive. That sort of held the rupee. But on the equity front, almost the entire amount of money that FIIs brought into 2024, almost all of that went out in a single month. That exerted a lot of pressure on the currency, which then means that from an FII equity inflow point of view, if that starts seeing a pickup, to a large extent, that can help stabilize the rupee, which means that in the months ahead, if FII into equity, if the momentum or the pickup of FII inflows into equity does not see a sharp pickup or does not see an appreciable pickup, the RBI will have to step in to iron out the volatility in the currency, and you could see some currency pressures ahead, which is why the financing of the current account deficit becomes so important. Now we come to the last slide on the E part of the E.M.I. This is the key variable that really matters for the markets going forward. What is that one wild card variable? One variable that if it turns positive or in India's favor, it can completely change India's fortunes. There's a lot of data in this chart. Please take some time to go through this. But the key point that we're trying to make here is after the US presidential elections in 2024 and after the Republican Donald Trump has become the president of the United States, the Treasury Secretary, the Energy Secretary, and the President Donald Trump himself, all of them have been highlighting one key variable. They're talking about more offshore drills. They're talking about more crude oil production. One must remember here is that the United States is the largest producer of crude, and it is the third or the fourth largest exporter of crude. So if at a point in time when crude demand is relatively muted, if there is an increase in supply over a period of time, that will put a lot of downward pressure on the price of crude. What happens if there is downward pressure on the price of crude? It really helps India. So we are roughly at around $75 a barrel currently, Brent crude. If you see a fair bit of a drop in crude prices, let's say $10, $15, $20, we don't really exactly know how much of a drop there could be or if there will be. But if there comes a situation where crude prices come off sharply, it will have a significant positive impact on India macro variable across the board. Let's look at a couple of variables. So we are just taking the 2014 crude prices came off very sharply from 2014 June onwards and are up to around February of 2016. Now, we're not saying this is exactly going to happen, but just as a case in point, an exaggerated example we take in, where we saw roughly around a $80 drop in the price of crude. It was from $111 a barrel to around $32 a barrel. What happened immediately? You saw a drop in India's imports, energy imports. Inflation came down, both your CPI or WPI, your WPI input inflation, output inflation. That allowed the RBI to cut rates by a sharp amount, by nearly around 125 basis points of rate cuts. The RBI was able to deliver because of this. India 10-year yields came down. As a result, you saw a fair bit of money coming over a 20-month period into net FDI. Equity saw flows, debt saw a fair bit of flows. RBI was able to amass all of these into inflows and build up its reserves by roughly around $31 billion. The government did not really pass through this drop in price. It increased excise duty, and that really helped them tide the fiscal situation. The 2.2 trillion rupees, 2.2 lakh crores is the amount of money over this 21-month period that just from diesel and petrol excise duty, the government was actually able to collect on the because WPI and inflation started coming off. Gross margin of BSE 200 companies started moving up. All of this gave a positive multiplier into the economy, and real GDP went up by around 3.7% or so. On the fiscal metric, you can see here, fiscal deficit, you saw a 100 basis points drop from FY14 to FY17 on the fiscal deficit, largely on account of this one variable changing. Your interest as a percentage of GDP came off because repo rates came off, US 10-year yields came off, the yields in the markets came off. The government was able to cut down its subsidy component, its excise component, like we saw above, went up. All of this helped the government to push up the capex as a percentage of GDP by 20 basis points from 1.7 to 1.9. So this is all a small single variable drop, which is crude price drop, can bring to the Indian economy. So if we see a sharp or an appreciable drop in crude prices into the quarters or the months ahead, one should expect a fair bit of a positive impact across Indian macros, across Indian economy and the fiscal as well. So these are the three key slides we wanted to highlight from the E part of E.M.I. Now, before we go into the M part, which is the markets part, I'm just talking about four key macro indicators from a momentum point of view, high frequency indicators. Your passenger vehicle sales have witnessed continued buoyancy in January, but if you look at passenger car sales, they continue to remain soft, just hugging FY24 levels, but notice that they are well below FY19 levels. Domestic tractor sales, they continue to hold up about 2024 FY24 levels. GST collection growth is seen back in double digits on the back of strong festive spends. Markets in January. Now, what was that key one variable that stood out for us for the markets in the month of January? You saw a fair bit of a drop in India 10-year yields. Now, we've written about this and we've talked about this earlier over the last few months, why India 10-year yields went up and why it actually came off. It went back up again, and then it's now coming off. It's currently at around 6.69, 6.7% or so. The entire positive narrative around 10-year yields started in 2024 January, and you had the entire bond inclusion narrative. You saw a pickup in confidence around India's fiscal metrics, and the most important was US 10-year yields started coming off, and as a result, India 10-year yields also started tagging that and moving lower. Now, how does bond inflows, FII bond inflows, look at this current point in time? So there are two key points that you have to remember here. One is, how have debt flows been from September of 2023? You can see that most of the debt flows that have come into India have been because of the bond inclusion narrative. So because India got included into the bond index, emerging market bond index, JP Morgan, we saw, this is from around July of 2024, we saw a fair bit of money come in. Markets were expecting in the first 10 months after bond inclusion, around $25 billion to come into the bond markets. Only around under $8.5 billion have actually come into the Indian market, which means that a fair bit of bond money, FII investment in bonds, have not possibly happened. And this first 10 months gets over by around April of 2025. And like we saw in the earlier slides, debt was one key element that really helped support the rupee despite the sharp outflow of FII from equity. Now, what is one key variable that you have to track? We talked about equity and how crude prices are something that you have to very closely track. And FII inflows into equity into the months ahead will be very important for the direction of the rupee or how much of pressure the rupee will face. Similarly, if I look at debt and yields, what is that one variable that you have to closely track? We talked about how US 10-year and India 10-year have been moving in line. But the US 10-year is very important for the India 10-year structurally. This chart here, the light blue shaded region, talks about the spread between India 10-year, a hedged India 10-year, and a US 10-year. So if FII brings money into India debt, let's assume he completely hedges his position. Just for an example's sake, let's assume that the India 10-year yield is at 6.8%. Let's assume the cost of hedging is somewhere around 2.8%. A completely hedged return will be 6.8 minus 2.8, which is 4%. And the US 10-year currently is trading at around 4.5%, which is 50 basis points above a hedged position in India 10-year, which means that there is barely any incentive for an FII to invest in the Indian bond market and get that 6.8% yield, which after hedging comes down to around 4%. So this light blue line tells you that until around December of 2024, that spread was positive and that spread turned negative, and which is that 50 basis points negative that I was talking about. So two things can change for this to turn around. If crude prices come off, like we saw earlier, bond will see a fair bit of flows in the expectation of rate cuts and yields will start coming lower. The second variable that one has to also very closely track is US 10-year. If for whatever reason tariff narratives actually turn out to be much more subdued, markets fear around inflation comes off in the US, or there is a fiscal spending boost in the US, dollar starts getting weaker, and as a result, you see some reaction in US 10-year yield, whatever the reasons may be, if US 10-year yield starts coming off, directionally the spread starts turning positive again, and then the incentive to can come back into FIIs to come back into the bond markets, come back all over again. Now, from a earnings and a PE and an earnings growth point of view, what really was interesting for the month of end of January was Germany topped earnings growth expectations for 2025. India was somewhere in the middle at around here. Remember here that currency also plays an important part in this earnings growth number here that we're talking about. You look at FII equity flows across key emerging markets. One key takeaway here is India is not alone in this entire outflow of FIIs from equity. Across emerging markets, we have seen this pressure. And lastly, on the market side, if you look at a sector-wise breadth of market momentum, so we're actually looking at the number of stocks within a particular sector that are above and below its 200-day moving average, which gives you a sense of momentum. You see here that telecom, technology, and energy and consumer discretionary, these appear to be four sectors which are not as negative on the momentum front as the general NSE 500 index, and also as compared to these three sectors, which are materials, consumer staples, and real estate, where more number of stocks are below their 200-day moving average in those sectors. As this is as of end January 2025. And lastly, the slide that we always talk about, large, mid, and small cap valuations, all of them had seen an appreciable amount of moderation in the month of January. The last segment now, what must you know before investing? We talk about two very important and very relatable points here. So from when can you expect higher chances of 12% SIP returns, 12% XIRR returns from SIP? There are three lines in this chart. So we'll start off with this. We had a detailed chart on just this one line a few months ago as to what is the probability of losing money if you are an SIP investor. What is the minimum time period that you should have as an SIP investor? We came out in that report and we said 7%. Sorry, 7 years is that number. So anybody who's an SIP investor, on average, if you are holding on to your SIP for a minimum period of 7 years, you have a 0% probability of a capital loss. But then you invest in the markets because you're at least looking at that 12% CAGR number or 12% XIRR number. What is the probability of making 12% XIRR if you're an SIP investor for a 7-year period? It's a 70% number. Now, we always want to keep increasing this probability. And if you are in the market for a 14-year period as an SIP investor, you make an 83% probability of getting the 12% XIRR return. If you're an SIP investor for a minimum 19-year period, 97% probability of making 12% return, and anything at 21 years and above, almost all the time, historically, you have seen on average, you've made 100% of the time you've made 12% returns. Now let's look at the two most important types of investors, lucky investors and unlucky investors. Now, the whole point of staying out and using time as your friend in the equity markets is to reduce the volatility, reduce the risk, and increase the probability of you being a lucky investor. So if you were the luckiest investor, what were your SIP returns like? This, the blue line, shows you that. If you were the unluckiest investor in the market, what was your return like? You notice here that whether you're a lucky investor or an unlucky investor, the more time you hold on to your SIP, the difference between the luckiest investor and the unlucky investor completely narrows out and almost converges beyond the 24th year. Now, where are we as we speak on SIP returns as of end of January 2025? If I plot SIP returns from 7 years until 25 years, why 7 years? Because in the last slide we showed how 7 years is the minimum time period for an SIP investor. All maturity or all time frames of SIP investment are well above 12% CAGR for SIP investors for all of these time frames. So the key takeaway from this slide here is time will completely iron out the difference for an unlucky and a lucky investor on the returns front. So the most important point to keep in mind here is it is time in the market rather than timing the market, something that we have been reiterating time and time and again. In these sort of markets, this is the most important. If your time frame is 7 years plus, you should be looking at a higher allocation for equity. But if your time frame is 7 years or 5 years or lower, asset allocation becomes extremely important. And lastly, a very important and a key quote of Warren Buffett. He says, opportunities come infrequently, but when it rains gold, put out the bucket and not the thimble. Thimble is that little instrument you put on top of your thumb when you sew clothes so that it doesn't really poke your thumb. Till next time, this is Arjun signing off. Have a great month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.